Welcome back to FT Markets. Mario Draghi, the European Central Bank President, wants to serve up a dish that revives the Eurozone when he unveils his ideas for quantitative easing later this week. He wants to boost economic growth and, crucially, lift inflation. But will the package be to the taste of bond markets? With me to discuss this is Laurence Mutkin, who's the Global Head of Rate Strategy at BNP Paribas. Laurence, welcome to the FT. What we've seen in anticipation of the ECB's announcement is a strong rally in bond markets, yields which move inversely falling to historic lows. Does that mean that QE is actually priced in to bond markets already?
Well, in some ways it means the opposite. If you think about what's been driving bond markets yields lower, a lot of it is a fall in break-even inflation expectations.
This is our first chart. We've plotted exactly that, the five-year inflation expectations. This is what markets expect inflation to be over 5 years, starting in 5 years' time, and fallen quite precipitously.
It has indeed, and since the summer when President Draghi mentioned that this was in some ways an implicit or explicit target of the ECB, you can see that the market's reaction, partly driven by the oil price, has in fact been the opposite of what we'd have expected if we really believed that inflation expectations would revive, which is that inflation expectations have fallen a further half a percentage point and taken down with them the 10-year bond yield.
These are German yields moving very closely in line with inflation expectations, which suggests that what matters, crucially, is what happens to inflation expectations after Thursday's announcement.
That's right, and I think that the test of whether the announcement has succeeded in being credible enough will be, do break-even inflation expectations, these forwards, begin to push back higher?
Back towards that 2% level.
Towards 2% would be a big move from where we are now, and absolutely would be a vote of confidence.
And presumably if they don't, we could see those yields fall even further.
I think if there was scope for a large disappointment, that's true. I mean, one thing to point out, though, is that it's not clear that it's all or nothing with the announcement of QE.
You mean how big and how unlimited, whether it's unlimited or not?
That sort of thing, and how it's going to be conducted.
Yeah.
In a way, the lesson we've had from the last 6 or even 12 months is the ECB can keep not quite doing QE, but perhaps make people think they're getting closer to doing QE.
Yeah, and there are lots of complications to Thursday's expected announcement. I mean, the questions about whether risks are shared between national central banks or pooled, the questions about how senior the ECB buyers would be, I mean, compared to private sector investors. These are all very important issues for markets.
They are.
And could affect which way yields go.
They absolutely could. I mean, I think the message that we've heard and the lesson that we've learned from UK and US QE is that the more explicit and determined the central bank seems about what it's doing and why it's doing it, the more likely it is to revive inflation expectations and revive animal spirits and economic activity.
So those sorts of facts will be more important. A crucial question, of course, is whether we have different effects in different Eurozone countries. We've plotted the bond yields relative to German bond yields in the 3 of the peripheral countries, Italy, Spain, Portugal. And as we can see, they've come down really quite dramatically since the Eurozone crisis, also in anticipation of QE. Could we see those divergences reappearing?
I think that this is, in a way, although it looks like these spreads have narrowed a great deal, I guess it's worth remembering that compared to where they were before the Greece crisis and before the financial crisis,
2010.
we still have a lot of spread, even though obviously we've moved a million miles away from before President Draghi made his famous whatever it takes comment. But I think the question about where these spreads go and the issue about risk sharing is an interesting one. On the one hand, we know that a lot of the members of the Governing Council are more hostile to QE, and politically outside the ECB, a lot of people are opposed to the idea of sharing the potential credit risk implicit in the ECB buying all the bonds.
Which has implications for those spreads. Yeah?
And that has implications for those spreads. But I think those implications need to be balanced by what else is going on. So effectively, what one's talking about is who would take the loss in the event one of these sovereigns defaulted. Would it be the national central bank or the system as a whole? But of course, by doing QE, if it's successful, you're reducing the probability of default altogether.
It goes back to your earlier point about the effectiveness and the credibility that the markets attach to the programme overall.
That's right. So I think the idea would be, even were risk limited very specifically to each national central bank buying only the bonds of its local government, if the overall effect of QE was strong enough in terms of size, in terms of impact, in terms of commitment from a wide range of people within the governing council, then I think that positive might outweigh any specific negative for any.
It sounds like you're going to have a very complicated day when the ECB makes its announcement.
I think we'll all be home late for dinner on Thursday.
Laurence, on that note, thank you very much. So, a real menu of possibilities there from the ECB on Thursday. Let's see what actually happens.